All right, everybody. Hello, good morning. I see some people are still joining. Welcome. Today, what I wanted to do is I wanted to go over a presentation that I gave about a week or two ago to clients over at Richland. And we had a lot of good feedback. And with everything going on, I really thought it would be helpful and still timely and very relevant information. So I'm going to go through all the slides. And then I'm going to have time for Q&A at the end. Also, they are jackhammering right outside my window, literally right there. They decided to start 5 minutes ago. So hopefully that's not too distracting. I'll try to speak over it. But at the bottom of your screen, you should see the Q&A. So click that. I have Carson and Miles that will be monitoring that throughout. And I'll definitely do Q&A here at the end. So here we go. Let me share my screen. All right. All right, so there is a lot to cover today. There's a lot going on in the world, as all of you know, if you turn the news on at all. Inflation, Ukraine and Russia, markets officially in correction right now. All of these are things that we're going to hit on. And I said this was more relevant in person than it is on a webinar, but I always tell people we have to play nice because some of these topics, you know, and especially going back to COVID and everything, are very or can be politically offensive to certain people or to, you know, depending on what's said. But I always do my best to give information to you that's relevant to your financial plan and not my personal opinions. But I don't think we'll have an issue today, again, being a webinar. And we didn't have an issue last week, but I always bring that up. Little icebreaker, little inflation joke. If you can't make fun about things when times are tough, what else? You know, I know what humor's for, but when you get a 1% raise, but inflation is 6.2%, I thought it was cute. All right, but let's do this. So we put together, this is, you know, with everything going on with Ukraine and the war, we wanted to share some perspective. So this chart, and again, it's very small and probably hard to see for you, but what it is it takes all the terrorist attacks back to around 1990. And the takeaway is that the market is and continues to be resilient. And it always goes back to its normal ups and downs, which are based on companies making money or not based on the headline news and the risk. So just something to keep in mind. Let me try to find a little tool here. There we go. And then this same thing here, but this is showing all the big market crises going back a lot further. I mean, gosh, you can see all these different things from the 87 market crash, the Gulf War, but like look at COVID back in March of 2020, market down 34%. 1 month later was up 25%, and a year later up 77%. I mean, who would have predicted that going through a global pandemic? We certainly didn't. We were happy to see it happen. I mean, I thought that would happen maybe over 2 to 3 years. But that's my point is we do not know, obviously, we don't have a crystal ball on what's going to happen with the Ukraine and Russia situation. You know, prayers are with those that are being affected by this war, and we hope for a de-escalation that is kind to humanity and also to the markets. But that's, you know, TBD, and we're watching that every day, and I know you are too. But I just wanted to give some perspective there. This was a tweet that I found, all very true. This is every correction since 2009 in the S&P. And you can see these are normal corrections, down 16, down 19, down 13, down 10, down 19. And then there's the COVID down 34%. And then this one, this is from like a week or two ago. It's still pretty close. I mean, we're in correction territory, which means the market is essentially down over 10%. Bear market and recession is 20%. We're not there yet. Pretty close. And we have touched that with the NASDAQ and technology. But you get the point. But I like this. Every time it felt like the world was about to unravel at any moment, you know the feeling, right? And this one feels like that right now too. Maybe not to some of you. And someday it's not going to feel like that anymore. So this too shall pass. And I don't know when. All very true. I just thought that was very timely. So let's talk about 2021. Bizarre year in the market. 5 companies, you can see them here, made up over half the return of the S&P from April to December. Of 500 companies, 5 companies made up over half. That is beyond bizarre. But I'm not surprised with everything going on. The S&P had 70 all-time highs in 2021. That's a record highest inflation since the 1980s. We are all feeling that. We're going to talk about that. A global pandemic, obviously. Um, and then, I had a lot of clients last week, and I get this in meetings all the time. Okay, David, what does your crystal ball say? What do you think is going to happen? Well, a couple of things I know. The economy now is really left to, it has to perform on its own. It's not going to be stimulus driven. I mean, the administration still wants to print some more money. I don't think they're going to be able to get that through politically. They've already spent 4, 5, 6 trillion dollars. Record amounts of money has been printed, which has devalued the dollar. It's going to be tough politically to get that through, especially with midterms coming up. We don't have super low interest rate. I mean, we do have low interest rates. They're not going to be as low. The Fed's committed to start increasing rates, and they have, and you're going to see that. So that's going to take some wind behind the sails of the market. And what I mean by this is we're going to have to go back to old school. What makes the market go up? I mean, typically it's consumer spending, capital expenditures, companies spending money. That's happening and that's out there, but that's going to have to to continue to take this bear market to the next level, or we're going to hit a stall in growth if that doesn't happen, because we don't have the government able to kind of pump the numbers up. There's still some good growth things out there. There's a lot of jobs still available, 11 million jobs. And the wage growth is the highest in 40 years. I was at Chick-fil-A the other day, and I think it said part-time workers were almost $20 an hour. That's a big change. So there's jobs out there, and there's higher paying jobs. Yes, there's inflation, but still, those are some positive things. And COVID, this transition. I'm not here to say it's over. I'm here to say that 70% or so of people poll and say that they're over it and they're kind of moving on, and the media now is really focused on Ukraine and Russia, and you're hearing a lot less about COVID. So there is a transition from pandemic to endemic that's happening. So my prediction, and this is coming from talking to a lot of non-media biased economists and a lot of people a lot smarter than me that Miles Carson and I and our investment committee speak with every week. We think single digit stock returns are still possible this year. Obviously that would change if this war escalates, but based on where we see, profits and earnings from companies going and being currently, that would be a realistic assumption if we had to guess. And probably, another year of negative returns for bonds, which I know is crazy because they're in a portfolio to stabilize. But as rates start to go back up, I think you'll see bonds start to produce some returns over the next couple of years. But bonds are not a great place to be now, but we have to own them because we don't want all of our money in stocks, and stocks can get really ugly fast if things escalate, and bonds will maybe down, but down very little compared to stocks historically. Continuing on some of my predictions, we think GDP in the US will be closer to that 3.75 range in 2022. It was around 6% last year. Both of these numbers are historically very high. I forgot the exact year, but like the 6% is one of the highest in maybe 20, 30 years. 3.75 is still good growth, but it's quite a bit less than last year. We have this thing going on called the Great Resignation. I talked about this a lot last week. Why is this happening? Why are so many people not working with higher paying jobs out there and with inflation? Well, they have a lot of equity in their homes. People's house values have gone up. They bought a house for 500,000. Now it's worth 800,000, and they feel, insulated there. They have equity in their home that they feel that they can take time to, they have enough now, and they don't need to stay in a job that they don't want to do, or they want to take a life kind of midlife time out and spend more time with the family or whatever, and utilize a home equity line of credit with 2% interest rates or whatever they are. That's going on, but that's not sustainable. So childcare has been hard for people to find. I've heard that a lot. If they can even find daycare and get their kids enrolled or find nannies, etc. People were very scared, although maybe not as much now, of getting out in the job force with COVID and everything. So a lot of dynamics. That's fascinating to me. So you have like 11 million jobs available, and I think 10 million or so unemployed. So we technically could employ everybody with higher wage growth, but it's just not happening. So that's going to be interesting to watch. Russia, Ukraine, I mean, it's not the size of their economy. I believe like the Ukraine economy was like $100 billion. And if I read this right, I think Walmart does that in 3 months. Kind of like back in the day when we were watching Greece default on bonds, and their bonds were paying 20%, but their economy was like the size of the state of Arkansas. It's more the headline risk, and it's more of the possible escalation of what's going on with Putin and Russia and everything that is more fearful and causing the markets to drop, not because we're worried about those economies affecting our economy. Both of those economies are very small in scale to what we're dealing with in the U.S. Homes, no surprise that houses continue to go up in value. I mean, it's simple supply and demand. There's a low supply, there's a high demand, but higher interest rates over the next couple of years, I think, are going to slow that down. I don't think they'll crash the housing market, but I don't think the values going up at the rates they are, especially here in Nashville, is sustainable. So that's something we're watching. I mean, 30 trillion of debt, that's a huge number. Okay. It's no secret that we've printed a lot more money in the last 2 years than ever in history. It's just a fact. It's not political. Inflation is really this simple. It's more dollars in circulation means they are worth less and less goods that you can buy with a dollar. And that's what's happening now. We're all feeling it at the pump and the grocery store, certainly on houses. Biggest headline now is interest rates are going up. Is this good or bad for the stock market? The way I'd answer this, it depends on how you look at it, right? It's bad because it means we're slowing down the flow of money and making it more expensive to borrow, okay? But it can keep us from getting overheated, right? Like with what we're experiencing now, where we had too many dollars in circulation and too much cash available, where prices have just gone through the roof. Looking at housing prices, like I said before, is that really sustainable? So it's good and bad. Little humor here. Cartoon. On Wall Street today, news of lower interest rates sent the stock market up, but then the expectation that these rates would be inflationary sent the market down until the realization that lower rates may stimulate the economy, and the market went back up before it ultimately went down. You get the point. The market's confusing, right? Day to day, it never seems to make sense. I've done this for 20 years, but over a period, let's say maybe 5 years or so, I think it tells a more predictable story. So I don't expect it to make sense on why was the market up 500 points yesterday, and then you go to lunch and you come back and it's down. We're seeing a lot of that. So usually back to interest rates, usually when the Fed starts raising rates, overall it's been positive, and that's also part of that is the market just tends to go up 75% of the time anyways. But you can see during these periods that the Fed has raised rates, overall the market's been positive most of the time. Another way of looking at it, or another way I looked at it here, shows initially sometimes there's a shock with the news, the market reacts negatively. You have some hiccups at the beginning, but then it settles and it adjusts and it accepts the fact that rates are going up. You get the initial pullback, and then the market continues to go up. And you can see here, usually over the next year, 5 to 10%, which is very close to like what I said this year. I could see the stock market doing in that, 5, 6, 7, 8, 10%, somewhere in that range, of course, depending on what happens with Ukraine and Russia. All right, so volatility is back, and it was pretty absent for the last 2 years, ever since the beginning of COVID, when the market fell 30-something% that first month in March of 2020. The market's only dropped, I think, 5% or so since March of 2020, and that is not normal. So let's talk about volatility. This is showing, let's see here. So this is showing the market. There we go. So this is showing the market since 2007. If you put $100,000 in, there's the big hit after 2008 with the Great Recession. Market fell 55%. And then it went up 500%. Then it fell 33% at the beginning of COVID, then went up 77% or 70%. You can see you ended up with 320,000. But a very, very sharp roller coaster ride to get there, if you will. What's interesting, we put this over here. This is looking at a 60-40 portfolio, which more of our clients are like 70-30, closer to, they're certainly not 100% stock. And you can see the difference of the ride, the extremes, down 34% versus down 55%. but then only up 300% versus 500%. Then we only fell 21%, not 34% at the beginning of COVID. And then we recovered 43%. So you're seeing like half of kind of the volatility on average, but you get to the exact same number. Now, why is that important? Well, it's very important because the overall experience for the investor is much healthier, more emotionally sustainable, and you're less likely, and our clients are less likely to pull the plug and yank their money or do something that we advise against and pull their money out of the market if they're not down 54%. 34% stings really bad, but it's where's that uncle point? And then, yeah, so one thing to point out is, like in 2008, if you think about it, like a Vanguard index fund, for example, like if you didn't have an advisor and you just bought an index fund or just, something with no fee, no advisor, it fell, you got 100% of the downside of the market. So you fell 50%. Well, what happens, hopefully you can see my little cursor here. If the market falls 50%, it takes 100% return to break even, right? So if our model, like in my other example in the last slide here, so let's say we only lost 30% in 2008, okay, which is indicative of a lot of our clients' experience in portfolios, depending on their risk and their model. I have to say that for compliance. But if you lost 30%, you only had to make a 43% return to break even. Remember, 50, you had to make 100% return. But let's talk about that. That's 57 years worth of our fee. If somebody's charging 1%. 57 years worth of our fee justified just by having you down less in 1 year. And that's what I try to stress to clients. That is, I cannot stress enough how important that is. So see, the fees are worth it that you pay a good advisor to hold you accountable to a plan. So that's as salesy as I'm going to get. All right, I'll get off that soapbox. But here's some other ways of looking at it. Just, you hear, like, if you're a client of mine, you hear me say all the time, 75% of the time, or 3 out of 4 years, the market goes up, and about 1 out of 4, it goes down. I mean, it's pretty over, there's 40 years. That's pretty accurate, okay? And about every 10 to 20 years, there's a really bad down year, right? Every 10 to 20 years. And then I tell clients all the time, expect on any given year, even when the market finishes up, you usually have about an average of a 10 to 13% correction during every year. That is normal. We didn't have it last year, which is, I think we forgot. And that's what this shows. So here's a year, market was down 16% at one point during the year, but it finished up 13, right? Here's, 2020, when COVID started, there's that 34% hiccup, but the market finished up 16. So that's normal. Last year, I mentioned the market only fell 4%. That is not normal. And then this year, obviously, I don't have the chart updated. So far, market's been down 10, 15%. So we'll see where it finishes up. And then I did the same chart, a lot of chaos here, but just the blue is basically just showing the average client, like where we have more like a 70-30 type of portfolio, not 100% stock, where, look, you're getting, in an example like 20, you only failed 21%, not 34. So it wasn't as big of a sting. So our clients weren't panicked as much, but they still finished up 14%, maybe not 16% in this example. So it's, how do we get less of the downside, because we know downside volatility hurts so bad, and how do we still get, even if we get 70% of the up and less of the down, that is a much better experience. Okay, so is inflation as bad as they are saying? Yes, I'd say it's worse. It's probably higher than the 7.9%, which is the latest reading that we heard. Why? I'd say it's because energy isn't included. And also, when you use the same formula that they used to back in the 80s, it's really around 16% or so, give or take. I think, it hits the middle class worse. Those making, families making 40,000, 60,000, 80,000, et cetera. The gas costs, food costs, housing costs, that's the biggest part of their budget. And those are all up double digits. So it is a big deal. Oh, wow, I forgot this was on here. Never did I think in my career I would have Snoop Dogg in one of my presentations, but I always like to surprise myself, right? And jokes are harder over Zoom, so I'm sure somebody out there has a smile. The US government telling you inflation really isn't that high, and there's Snoop Dogg doing his thing. I think you get where that's going. So hopefully that provided a little comic relief. All right, let's look at inflation. So I'm going to talk about 5% inflation. Now, we just talked about how it's between 7, maybe 16%, 7 to 16%. even if we assumed it's 5%, which for the next 20 years, 30 years, if you had $100,000 today, in 25 years, that 100,000 at 5% inflation is only worth $30,000. Now, look at that another way. It would take $338,000 in 30 years to buy the same amount of goods that 100,000 would buy today. So you can't afford to keep all your money just sitting in the bank, making 0.5% or under your mattress. You have to be in stocks or real estate to have some sort of return to stay in the game, and so that your purchasing power doesn't go down. So that's why if we can, kind of help clients with the downside volatility so they don't pull the plug, to give them the chance at getting those 5, 6, 8, 10% long-term returns, they're going to be a lot better off, especially with inflation. These new $1 bills are awesome, aren't they? That's a $10 bill. It's another joke. All right. All I want to show here is that, and I've shown this before, and I always bring this slide up during election time, is that investing based on your party, Republican, Democrat, being in office, is a horrific, horrible financial plan and strategy. I think back to clients that when Obama got in, they wanted to pull their money out. They thought it was the end of the world as we know it, or the market. And then those thought the same thing about Trump. Now Biden. We can see what happens to the market when you start to spread it over a long period of time. There's likely a red wave coming back in November. Pendulum will probably swing back, probably because there's not enough time for Democrats to get the economy settled the way they need to, and that's to be expected. It's what happens during every administration. So what's next? Or a couple other thoughts. Build Back Better appears to be dead for now because of a couple senators, and I don't think Biden's gonna be able to get that done, especially with inflation. The argument to spend a lot more money, even if you agree what's in the bill, there's always some good things in bills like that, and there's always also a lot of devil in the details from both parties. It's a tough time to do it, to justify it. COVID restrictions are easing, very much so. Interest rates are rising. The market's having to work a lot harder for small gains. It's not going to be as fun on our side of the table or yours looking at your statements as it was in 2020 and 2021. Technology has never moved this fast, and it's never going to move this slow. I mean, it's just going to continue to drive everything. It's unbelievable what's happening out there. They do a whole presentation on that. The housing market was caused by one shock to the system, meaning people making big life changes, people moving, people leaving California, New York, Chicago to come to places like our hometown here in Nashville, where the housing market's gone through the roof. That was caused a lot because of COVID restrictions and different things. That is now kind of subsiding. So what happens now? Taxes. We were way wrong. Biden threw out there having capital gains rate at from 20 to 40%. We were preparing for the worst. And none of that's happened. And I'm selfishly glad, because it helps our portfolios, and I think it's better for the market now with inflation and everything, not to mess with taxes, because the last thing you want to do is double taxes for the business owners, and who are then going to lower their wages again because they're just now increasing wages. So we want to see that get into the hands of the workers, not necessarily the government. That's as political as I'll get. Yeah, just ignore the headlines. I mean, there's always negative headlines out there, and there's a lot of them right now, and rightfully so, with war going on. We have a country that is spending too much time thinking about government, which means less time thinking about innovation or producing goods and services that people really want. So how do we beat inflation? Stocks and real estate. That's it. Not cash, not bonds. Got to have some of each, but you need money in stocks and real estate to stay in the game. As we have these market pullbacks like we're having now, my gosh, if you have cash, if you're still working, if you have a bunch of cash sitting on the sidelines, put it in the market. Consider it a buying opportunity. It is not fun to do. I've done this for 20 years. I hate doing it. I have to do it robotically because I'm still an emotional being, and I will second guess myself unless I have a system and have my team do it for me. Don't invest with your politics. The market has and does, and I've seen it, and it would myself if I wasn't process driven. It makes fools out of the smartest investors all the time, every day. So as your financial planner, what can we control? And that is always going to be planning, our 3-bucket strategy, the retire while you work strategy that we talk about all the time. Those are the things that are more relevant and we need to focus on, so that you're recession proof as possible when things get really bad and you can weather the storm. All right, gonna do questions here in a second. These were just a bunch of random stats that I found I thought were interesting that I read to the group and kind of triggered some interesting conversations. So I'll read these really fast, or I guess you can read them, but I'll hit the highlights. A person with $1 million invested in the S&P in 1973 who was taking out $100,000 a year was out of money in 9 years. But that's taken out a 10% withdrawal. You hear me talk about 4% is normal, but that's interesting. But then another person started in 1982. So they skipped all the bad markets in the early 1973, which was like a 2008. They took out 100,000 a year. They had over 7 million remaining after 40 years, just because of the timing and the sequence of return. That's why it's important that you have a team like us monitoring it like a heart rate throughout your retirement, because you have no clue what part of history your retirement is going to land in. A child born in 2022 years ago started college. If their parents invested $150 a month, and they had made 8% on their investments, the parents would have been able to pay for their children's 4-year college expenses. That's for public school. So that was $88,000. But the average cost of private school is about $50,000 a year. So, we can run projections for you. That was just interesting. So $150 a month. If you start early, the power of compounding interest for private school or public school. So private school, maybe it's $500 a month. This was interesting. The United States, well, actually, it's probably surprising to a lot of us. The number of births has gone way down. We're having less children. That's not a surprise. People are waiting later. People are making different decisions. Student loan debt in the United States was 84% larger than credit card debt. So there's $1.5 trillion of student loan and only 860 billion of credit card debt. I didn't know that. I would have thought it was the opposite. So interesting. 3.3 million Americans died in 2020, but of that, only 1,275 paid estate taxes, down from 139,000. Why is that? Well, the estate tax, the death tax limit exclusion, if you will, is like $10 or $11 million a person. It used to be like $1 million. It keeps going up. Trump raised it, and it hasn't changed in a while. So, that's something the IRS is looking at. They could lower that to 2 million, and then all of a sudden, a bunch more people would pay a estate tax. Americans added another $1 trillion of household debt in 2021. Okay, why? Low interest rates, right? And that's why inflation's up, and some of that's good, but some of it's gotten overheated, double-edged sword. 58% of workers during November 2021 were working part-time in an office environment and part-time at home. That's an increase from 46% just from May of last year. So what's that mean, bosses? And the trend continues to be to allow people, or at least be open to people maybe a day a week, or, just having some more flexible work environment, thanks to COVID. 27% of American adults earn money from activities, outside of their normal, 9-to-5 job, if you will, childcare, house cleaning, Uber driving, that sort of thing. Average price of a new vehicle was $45,000 last year. It's an all-time record, and used cars have gone up. Some used cars cost more than new cars, just because people can't get new cars on time. Yep. This is the, we've had 11 recessions in the last 70 years. This is referring to March and April of 2020. That was the shortest recession. It only lasted 2 months. Recession is market falls more than 20%. Market fell 34%, if you remember that earlier in this presentation, and it came back in 2 months. That's crazy. I'm not even really a sports guy, but I thought this was interesting. In the first 54 Super Bowls, no NFL team played and won the game on their home field. But in the last 2 Super Bowls, the winning team, Tampa Bay, and then the Rams, this past year, played and won on their home field. There you go. Questions? Please. All right. Okay, so I see no open questions right now. Is that even possible? I don't know if that's ever happened. Or did I just do that good of a job explaining and everybody's comfortable with my advice and the state of the world now? That's unlikely too. I'm gonna give you a couple minutes if you have any questions. And if no, there comes the jackhammer. That was perfect timing. That gave me a break. If you have any questions, type them in. If I don't get a question here in a minute, you know that you can email me directly. If you're a client, you have all my information. If not, david.w.adams@raymondjames.com. Let me know if I can help. Let my team know if we can help. We love what we do, and this is what we do every day. And we're staying on top of this stuff and working on portfolios, coming up with plans on what to do if different things are triggered with the war and that sort of thing. So we're here to help. I don't see any questions, so I guess I'm going to let everybody go. Thank you for listening. We'll send out a recording as well and put it on social media and all that good marketing stuff. And we'll talk to you soon.